On the 1st of January, a new tax will impact all investors in Belgium. But how does this tax work and what do we know about it right now? This is what we cover in this masterclass presentation with Pieter van der Velden, the author of the white paper on this topic for Vermorgensgids. From what we know of the tax right now, it looks like we are all going to need to learn to deal with it, even if we are investing with a Belgian broker, which is why this episode of the FIRE Belgium Show is so important for all investors in Belgium. In this presentation, we cover who will be subject to the new tax on capital gains in Belgium, what will be taxed, including the 4 categories of assets that will be subject to the capital gains tax, and the assets that are exempt from the tax, when will the taxable event be triggered, and also what happens in case of gifts and inheritance, or if you move abroad away from Belgium, how much tax you will need to pay, so how it's calculated, but also the impact of historical gains and losses. What about transaction costs and foreign currencies? How does the FIFO principle work in practice? And what are the exceptions? Why you have to keep track of all your investments in the past? How does the 10,000 euro exemption actually work? And how does the 1,000 incremental annual exemption combines with all this? And finally, what does this all mean for index investors in the short term and in the long term? So if you're an index investor or you're curious about this new tax, then this episode is for you. And in case you want more support after listening to this masterclass, you can always book a call with Pieter directly. We're sharing the link in the description. And if you're new to index investing, then I invite you to come and watch the free workshop on index investing for beginners on the FIRE Belgium website, where I explain basically how it works and how you can get started with the right support. All right, let's go. All right, everyone, welcome to this meetup on the new tax that is coming up in January 2026, the new Belgian tax on capital gains. Today, we have an immense pleasure of welcoming Pieter van der Velden to present to us the results and the outcome of his work and research that he's been doing for the past few months. Pieter, would you like to introduce yourself?
Sure. Yeah. Thanks, first of all, for having me, Sebastian, and also from my side, a warm welcome to the audience that is joining us tonight. So my name is Pieter. I am Dutch, but most of my life I've lived in Belgium, and that's where I still live, and I call Belgium home. By profession, I'm a chartered public accountant, worked in audit for many, many years, and then subsequently had a long career with an international fast-moving consumer goods company, which took me to multiple countries across the world where I worked and lived in all sorts of different environments, also tax-wise. And I came back to Belgium a few years ago, and I'm now working as an independent consultant, mostly helping private individuals on their wealth building journey towards whatever goals they have, which are usually retirement or even early retirement. And taxes are an important part of that. And that's why I think tonight we're going to talk about this new capital gain tax that will be introduced in Belgium quite soon, actually.
Yes. And we're very grateful for the work you've been doing and that you're sharing it with our community. I understand you're doing this with Vermorgensgids, with Tim Nijsmans.
Correct, yes. So I'm collaborating with Tim Nijsmans' Vermorgensgids. I think the Flemish-speaking people in the audience might recognize Tim Nijsmans and his book, The Hangmatbelegger. So I'm mostly working with him, but also trying to support this community and helping the good work that Sebastian is doing to educate people and to also help you guys along your journey towards financial success.
Yeah, in fact, we were talking about bringing you on the podcast on a different topic before this, on bonds, which I'm hoping we'll be able to do at some point next year. After this big topic is kind of better understood, we'll focus on this topic for a while before we go to talk about the other ones. But yeah, and you're also a very active contributor in the FIRE Belgium community, and I wanted to thank you for that, for sharing your knowledge and helping a lot of people, because it's now 10,000 people in the Facebook group and a much wider community, but 10,000 in the Facebook group. So thanks for that.
Fantastic. You're welcome.
All right, then the floor is yours. I might ask you a few questions here and there to clarify, but generally it's mostly your presentation. For those of you who are listening to the audio version of the podcast, we will obviously try to explain everything verbally, but it makes sense for you to come and check this out on the YouTube channel of FIRE Belgium, Sebastian Aguilar, and you will have the visuals, which I think in this case are very, very useful. Right. Let's go
I
then.
fully agree, because I think the visuals help to clarify a number of quite complicated topics. So
Yeah.
those definitely help. Yeah, I hope.
Excellent.
At least that's been my attempt for tonight.
They do. I mean, I looked through the
Yeah,
presentation. It's amazing. So yeah, it's
yeah.
very clear
Thank you.
with the pictures. Let's go. Yeah.
All right, fantastic. Then let's dive in, because we have really a lot of ground to cover. So let's get going. Maybe before we really go into the content, a quick disclaimer. Like I said, I am a chartered public accountant, which also means that I'm tied to a number of ethical and professional requirements. And one of them is that I need to explicitly tell you that I, tonight in this presentation, do not act in my capacity of chartered public accountant, and that this presentation is really meant for general educational purposes, and that it also isn't meant as legal, tax, or investment advice. And that also, finally, I might mention a couple of financial instruments, and I might hold positions in those instruments myself. So with that legal stuff out of the way, let's start. And I think, and you might wonder, what has an onion to do with capital gain tax? But I think it's a very nice metaphor to depict how complicated this tax really is beneath the surface, and that to really go to the core of what this new taxation is about, we really need to unpeel the onion and go through multiple layers of content to really understand how everything comes together. And only by doing that, I think I can try to help you show what this tax will eventually mean to all of us being in Belgium as taxpayers. So I think the onion is a good metaphor for this presentation in that sense. And to start to unpeel that onion a little bit, if you look at this complicated capital gain tax from 30,000 foot elevation, then you could summarize the whole tax or the whole law into one sentence, which is that it's about a tax which is going to start on the 1st of January 2026 on realized capital gains on financial assets. And I think that already gives us a number of building blocks or talking pieces to discuss. So it's a tax, so we need to discuss who will be taxed, so who will be subject to this tax, understand what are the tax rates, what are the exemptions, and all sorts of exceptions that we need to work with. And especially, of course, how will this tax be collected by the tax authorities from us as Belgian taxpayers and investors? So we're going to talk about those topics. The effective date, so the starting date, will be the 1st of January. That means no retrospective application. So the application will only be going forward as of the 1st of January next year, or coming January. And that also means that, and that's very important, historical gains from before the 1st of January won't be touched by this new tax. And I think that's maybe one of the most frequently asked questions during the past couple of months. So later on in this presentation, I've included a little example to show you how that works. And hopefully, if you still have any concerns about historical gains being taxed, completely remove that concern for once and for all. Subsequently, it's about realized capital gains. For now, and I'll show you why it's a bit more complicated, but for now we can say that only once you transfer or sell an asset to somebody else, this capital gain tax will be triggered. And for now, it's okay to say that if there's no sale, there's also no taxable event, but there are special situations or special provisions that we do need to talk about, because in certain events, there could be a taxable event even if you don't sell. So we'll talk about that. It's about capital gains that you realize. So that's really the difference, the positive difference between the sales value and the acquisition or the purchase price of an asset. And as we will see in this presentation, the law contains a lot of requirements or rules for this calculation of the capital gain on a certain transaction, and has a lot of provisions and exceptions and special requirements for that. And I think it's really important to go through that together step by step, because that will then determine how much tax you will eventually end up paying. And I think this is also a good point to mention specifically that it's really about capital gains and not about direct income from investments like interest and dividends and royalties. Those are not touched by this particular new tax. And of course, as you know, we already unfortunately have other taxes in place on interest and dividends, but that's not going to change because of this taxation that we're going to discuss tonight. And lastly, it's on financial assets. So we need to understand which financial assets are taxed and which ones are not. So I think this nicely summarizes the topics that we're going to discuss. And to give even a bit more structure around that, I came up with a couple of chapters. The first one is who will be taxed. The second is what will be taxed. Then we're going to talk about when will you be taxed. Fourthly, how much will the tax be? And how will the tax be collected? I think those are the 5 key questions. And I'm going to use those 5 key questions as topics or as chapters in this presentation. And we're going to go through those questions one by one. And hopefully, after we've talked about those 5 questions, a lot of things hopefully become a bit more clearer. And I'll wrap up with a quick overview on a few other taxes that are investment related and discuss to what extent those are impacted. And I'll briefly mention, should you be doing anything right now, or is it better to wait until the 1st of January? So what's next for the next couple of months? Before we really go into the first question, who will be taxed? I do think it's important to very briefly talk about the current status of this new law. Because at this moment, what we have, and that's all that we have, is the draft proposal for this new law with the so-called explanatory memorandum that goes with the draft law. And the challenge that we currently have, and that also gives a little bit of uncertainty at this moment still, is that what has been published in July, I believe it was, is still open to some interpretation, and on some very technical details, items seem to be missing or need further clarification or guidance to really understand, especially on bonds, so on fixed income, but also on derivatives, how this new law will be treated or how the calculation rules will go. But more importantly, this draft law still needs to be evaluated, which is currently ongoing. And I do expect some outcome, maybe even this week already, of the evaluation by the Raad van State or the Conseil d'État, which might also require the legislator to make a few technical changes to the proposed law. After that, so after the updated version is done in the next few weeks, that still needs to go to the government and the parliament, who then need to give their final approval to the final version of the law, which will then be made public through a royal decree. And only then it becomes law that can be implemented. And all of these pending steps need to be taken in the next few weeks and months before we know how everything that we're going to talk about tonight will actually work in practice. So it could be that even tomorrow, what we're going to talk about tonight might be slightly different if the Raad van State or the Conseil d'État has some amendments to the law. So this is not the final version yet, and there might be small technical updates coming in the weeks to come or in the months to come.
Interesting. And so,
yeah,
Peter,
yeah.
I don't know if you have an idea of the type of time frames that this requires normally, and whether they actually can do this within 2 months.
I try to find if there's some kind of agenda, but I haven't found that. I think the Raad van State or the Conseil d'État is nearly finished with their evaluation, so that really should come out very quickly. And I think some information has been leaked already on Friday or Saturday this weekend, and they don't seem to have a lot of observations, which is a bad and a good thing, because I was hoping that they would reject a few very complicated or strange legal things. But the good thing is that if they don't have a lot of changes, then the whole approval process in Parliament can go quite quickly, hopefully. And I think the sooner the better, because then as a taxpayer, we know what's coming, but also the brokers who need to implement this need to know how to adjust their systems and how to make this possible from an IT perspective.
Yeah, it feels like there's very little time to do this,
Absolutely, absolutely.
especially as not confirmed. So
Yeah,
okay.
yeah,
Let's see how it
and
goes.
that's going to be a very interesting topic, because the Federation of Belgian Banks and Brokers have already flagged their concerns, that they say, look, this is so complicated. There's no way on earth that we're going to be ready on the 1st of January. And the government already gave some hints about how they will give a little bit of leeway to the brokers and banks, but with the explicit mention that the tax will still go into effect on the 1st of January, but the brokers will get a bit more time to prepare their systems,
And
which,
process it.
yeah, feels a bit uncomfortable to me.
Yeah, I agree.
Yeah.
I wouldn't want to be an IT guy in one of those brokers right now.
True. Yeah. So I think it's going to be a few interesting months to come to see how this all plays out.
Best of luck
eventually.
to all of those who are involved in this
Yes.
and who are listening.
Exactly.
All right. Thanks for that.
All right. Then moving on. So the first chapter, and that's the shortest chapter, I think it's only 1 page, is who will be subject to the new capital gain tax. And the very simple answer to the who question is basically all natural persons. So that's people like you and me that are subject to the Belgian personal income tax. So the personenbelasting or the impôt de personne physique. Anybody who files a Belgian personal income tax return is also subject for this capital gain tax. So that's you, me, and everybody else in this audience probably. Good to mention maybe, but maybe not so applicable to people in this audience. It's also going to be applicable to certain legal entities that are not a company, so non-profit organizations, associations, private foundations, but also universities who also sometimes sit on a lot of capital, are also going to be impacted by this tax. And maybe also good to mention for any business owners, corporations, so legal entities that are subject to corporate income tax, are not subject to this capital gain tax inside the corporation. So inside the legal entity of a BV or NV, or in French SRL or SA, this tax will not apply. But of course, if as a natural person you are the shareholder of a company, then your shares in that company at a personal level will fall under the capital gain tax. So then the next question is, what will be taxed? And that's also relatively easy still. The complexity will come later on. So the new law clearly defines 4 distinct categories of financial assets that will be subject to the capital gain tax. And if you go through the law and the memorandum that comes with it, you'll see that the description of those categories is quite broad and very comprehensive. So they really capture a lot of different assets. And the first category is, again, or immediately is the biggest category, which is financial instruments, which includes all types of equities and fixed income, so shares and bonds, regardless of whether they are listed or not listed. All ETFs, but also exchange-traded notes and exchange-traded commodities are part of this. All investment funds, whether those are index funds or actively managed funds. All derivatives are explicitly mentioned with lots of examples, and all money market instruments. So basically, all the regular investments that I think the average investor has access to, all of those are captured by the capital gain tax. The second big category is the savings and investment insurance products that are very prevalent in Belgium, the different branch 21, 23, 26, 44, and then you name it. All those branch insurances are captured by this capital gain tax. And interestingly enough, the law also specifically says that any foreign insurance that resembles any of these Belgium branch insurances is also captured by the capital gain tax. I think some Belgians might have certain branch insurances with Luxembourg providers, and those are also captured by the capital gain tax, or in any country in the world, basically, if they resemble those Belgium insurance products. All crypto and anything that remotely even looks like crypto is included. And what I really found remarkable when I went through the law and through especially the memorandum, the explanatory memorandum, is the remarkably extensive wording in the law and the memorandum on crypto, which really kind of sends a signal that they've really gone through a lot of effort to make sure that anything crypto related and all conceivable transactions that you can do with crypto are explicitly included in this law. So they've definitely invited some crypto experts in writing this law, which is very interesting. But what's also going to be very interesting is to see how they are going to audit this, because I think that's going to be extremely difficult with crypto. But for now, I think it's good to understand that crypto is definitely included and seems to be the highlight of the day for the person who wrote this law, as they've really spent some time on crypto. And lastly, the fourth category is formed by currencies. So any investment in foreign currencies that you might have, including what's called investment gold. So those are gold bars or gold coins that you can use as payment. And also here you see that they really thought of the future, that they also said if in the future there will be digital central bank currencies, also those are included in the capital gain tax. So those are the four categories of assets that are included. What is not included, or which is excluded, and I think that's very important, are long-term retirement saving plans. So the typical second and third pillar retirement provisions that a lot of Belgians or Belgian companies might provide, like pension funds, group insurances, or other pension savings plans, are all excluded from capital gain tax. So I think that's good news. And the question that I have, and I can imagine that especially in this audience tonight, there might be several people that are living as an expat in Belgium or that have moved from other countries to Belgium and that might and who might in the future receive pension payments from other foreign pension plans. The question there that I still have is how those foreign pension income plans or income from those pension plans will be treated in the future, which is not explicitly mentioned. And I do hope that they are treated as if they were Belgian plans and that those foreign retirement saving plans also turn out to be tax exempt from the capital gain tax. So that hopefully also will become clear in the weeks or months to come. The next topic, and here it already becomes a bit more complicated, is what exactly triggers a taxable event? So when will a tax liability arise for this new capital gain tax? And of course, the first important thing to note here is that the effective date will be the 1st of January. And like I said, we're going to talk about how that is going to be implemented in an example later on. But anything that you do before the 1st of January won't be impacted by this new law. After that, so anything that you do after the 1st of January will be subject to the capital gain tax. And the key principle here, and I've tried to avoid using jargon or technical terms, but here I make an exception to that. The legal wording for what triggers a realization of a capital gain is what is called legally a transfer under onerous title. And that is important to explain a little bit. So what does a transfer under onerous title mean, this legal term? It means that you transfer an asset so that, for example, the seller transfers shares to the buyer, and this under onerous title means that the buyer of those shares gives some kind of payment, some kind of consideration in return. So you're not giving away shares, you're not transferring shares for free to somebody. The person you transfer shares to needs to pay for those shares. And when that happens, so when you transfer assets to somebody else, to a third party who pays for those shares, that's a transfer under onerous title. And of course, in general, day-to-day speak, that means that you actually sell an asset, as you and I would talk about that. And selling an asset triggers the realization of a capital gain. And to turn that around, it also means that as long as you don't sell, there is also no capital gains liability. So I think that's an important thing to note, especially for the buy and hold investor. As long as you don't sell, there's no liability. Except, and I'll come to that, there are a few special provisions in the law that talk about transfers without an onerous title. And I'm going to talk about that in the next slide. And there are a few what they call legal equivalencies where there's no transfer at all, but you're still considered to have realized a gain. And also on that topic, because that might also apply to a few people in this audience, I'm going to elaborate a little bit more on that in a minute. So what is this transfer without actually getting paid for the assets that you transfer? You might think, well, who would do that? But if I show you the examples, you probably agree that a transfer without onerous title is actually more common than you might have thought, because examples of those type of transfers where nothing is paid in exchange for the assets that are being transferred are gifts, for example, if parents give assets to their children, inheritances upon death, if you inherit assets from somebody else. I think those are two very obvious examples where assets, for example, shares, are transferred from one person to the other, but there's no payment from the receiving party. But also in case of marriage or dissolving of a marriage, you might bring assets from both parties to a marriage into a marital community, or you might take those out again of that marital community. And also there is no actual payment. And I think because gifts and inheritances might be quite relevant and quite common, I've included a little example here to show how that works in practice. So let's assume we have two parents that purchase some shares in 2026. So at that moment, the capital gain tax is already in effect. And for those shares that they buy in 2026, they pay a price of 100 euros. That's the acquisition price that the parents pay for these assets. And the parents decide to hold on to those shares for a couple of years. And in a few years later, in 2029, the market value of those shares have risen to 120 euros. So at that moment, the parents have an unrealized capital gain of 20 euros. They didn't sell those assets, so it's unrealized, but it did go up in value. At that moment, the parents decide to give those assets, those shares, to their child. So they do a transfer to their child. And of course, obviously, since it's a gift, the child doesn't pay for those shares. So this is an example of a transfer without onerous title. And what is very important here to note, and that's why I included this example, because there is no compensation paid for those shares, the capital gain tax that normally would arise if those shares would have been sold at this moment is not actually levied at this moment. It is not required, you don't need to pay that at this moment, but it's going to be deferred. And how that will work will become clear if I continue the example. So in 2029, the child has received from his parents or her parents these shares that then have a value of 120. There's no capital gain tax to be paid at that moment. And let's assume that the child holds on to those shares for quite a few years into the future. And in 2035, he or she decides to sell the shares, which at that point in time have a market value of 180. So at that moment, there is a realized sale. The child sells the shares on the stock exchange and receives 180 euros in return. So that means that during the period that the child was the legal owner of these shares, a further capital gain of 60 arose, which means that counting back from the acquisition price of these shares by the parents of 100 euros, the total capital gains on these shares is 80 euros. And the child is now liable for the capital gain tax on the entire 80 euros that is realized from the very first date that those shares were bought initially by the parents and that were then subsequently transferred to the child through a gift and that are then sold by that child years later. So I think it's important to understand that giving something to your children, or if you inherit something from your parents or other family members, at that point in time, there's no capital gain tax, but the person who receives those assets will receive those assets together with a liability over on the previous capital gains that have risen before the gift was made, and that the receiver, the child in this case, is liable for all the capital gains should he or she sell that asset at some point in the future. So financially, that's important to understand, but it's also important that whoever receives assets in the form of a gift or in the form of an inheritance also receives the original purchase documents from the initial purchase of those assets by the person who is giving those shares in this example, because eventually, once the receiver of those shares sells those shares, he or she needs to be able to demonstrate how much those shares were initially bought for and when they were bought. So documentation-wise, this is also extremely important to keep in mind if you are on the receiving end of a gift or an inheritance after the 1st of January 2026, that you not only receive the assets, but also all the documents that come with it.
Yeah, and this is important because there needs to be a really strong communication at the time of inheritance, hopefully by the parents before, if they were to pass away, or before the gift, right? Or as the gift is being made, but also by hopefully the people who are involved in making this happen, is
Absolutely.
so that the kids are aware that they're receiving something, the inheritance, but not all of it is net of, like, it's not net of tax. There's already a capital gain there that is obviously subject to capital gain tax, and there is still already now there's people who are inheriting money, including accumulating bonds, right? Or bond ETFs.
Oh yeah, that's the
where
same.
This is already a surprise because there's a 30% capital gain tax on accumulating bond ETFs. And so some people who are inheriting then are surprised that they have to pay so much money when they sell the asset, and they're not always aware of it. So this is going to become even more important because now it applies to all assets, practically.
No, that's
so we will see,
correct.
We will see this being a surprise for probably the first few people who go through this, and hopefully then we build a good practice of communicating on this.
True. And not to scare people, but more intended as a warning to make it even more of a surprise. What could also happen that, and I think I didn't include that in the slides tonight, but if you sell assets and you cannot demonstrate for how much those assets were originally purchased, the law is very simple. It says, well, then we assume that you got those assets for free, and that and that the entire proceeds from the sale is profit. And that is definitely something you really want to avoid. So if you cannot demonstrate for how much when and for how much you bought something, you're really in a bad position.
Wow. Okay.
Yeah.
So I was going to assume, well, okay, they go back to the value of the 1st of January 2026 if that was a value that was available.
Yeah. True. Yeah. No, I do think that is the case. That's not explicitly stated in the law, but that's also my logical interpretation. That it does
you have
go
to prove that
back.
You bought it before, or
exactly.
But then if it's after, you cannot buy it for. Usually, you cannot buy it for less. But maybe you can, in fact, and you just can't demonstrate it because you're hoping to go back to the 1st of January because the value was higher. So there's something there, right? It basically
true.
Like it's high penalty because if you can't prove how much you bought it for, and there is a chance that it was lower than the price that it would be on the 1st of January 2026, then the only way to enforce this correctly is to have a very severe consequence to cheating.
I do assume, but that's my assumption, that it will work like that. But in the law, the only thing that it says is if you can't demonstrate the actual purchase price, we will set it to 0.
Yeah, which makes
Full
sense so
stop.
that people avoid,
Yeah,
losing the traces of purchase on
yeah,
purpose
yeah.
if it makes sense for them, right? So
True, exactly. Yeah,
okay, so
and I
this is
think
really
this is
severe. Yeah.
yeah, and it's applicable in this example, but also, for example, people that trade crypto, where you might not have a lot of documentation on where and when and how you bought something. This could also be relevant, that if you can't demonstrate for how much you bought some Bitcoin at some point in time, you might also be in a bad place.
Yeah, it's not as bad
Yeah.
as losing your wallet key or something, but it's
No,
still bad.
true. Yeah. All right.
All right, thanks for this. Very
Yeah.
useful. Let's carry on.
Then, as I mentioned, and again, sorry for the technicalities, but yeah, don't shoot the messenger tonight. I would say there are a couple of so-called legal equivalences of certain transactions where the law says, well, it's not really a transfer, but we do consider a capital gain tax being realized. And they give two examples, or that's the case in two examples. First of all is early withdrawal from whole life insurance products. So those are insurances that are supposed to pay out upon the death of the premium of the insurance holder.
Mm.
But sometimes you can choose to take out money from those kind of insurance products before you pass away. If you do that, then that's also considered the realization of a gain and you will be taxed on that. So you can do it, but you need to be aware that you will be taxed. If you don't do that and the policy pays out upon your death, then it won't be taxed with capital gain tax. The second one, and that's the one where I want to spend a little bit more time, is the law also by fiction assumes a full realization of all your unrealized capital gains since the 1st of January, the moment that you leave Belgium and that you shift your country of fiscal residency to another country. And I think, and that's also, and I think in the media, that's also has been picked up. That is what is called the exit tax liability. And I'll try to show how that works again through an example. So let's assume you currently live in Belgium. You are a taxpayer, so a tax resident of Belgium, and you continue to be a taxpayer and a tax resident in Belgium until the end of 2027, for example. On the 31st of 2027, you decide to leave Belgium and to move to, let's say, to Spain in this example, random example. So at that moment, you change your fiscal current country of residency from Belgium to Spain. And that will trigger a couple of things. And I think those are really important to realize, especially because I think in this group, there are quite a number of foreigners who might eventually return to another country or move to another country again. Any unrealized gains that you will have on the date that you leave Belgium, so in this example, on the 31st of December 2027, that have accrued since the 1st of January 2026, so gains that have accrued since the start of this new capital gain tax, will be taken into consideration. And the starting point for this exit tax, and don't worry, as we'll see, it's not as bad as it may seem right now, but the starting point is that the law assumes that the moment you leave at the end of 2027 in this example, that by fiction, you realize all your unrealized gains that you're sitting on your entire portfolio since the start of this law in 2026. So the moment you leave Belgium on the 31st of December 27, you will have a capital gain tax liability on all of your unrealized gains. But fortunately, the law says, well, it would be a bit weird if we would actually ask you to pay the taxes on that the moment that you leave Belgium, because you're not actually selling those assets upon leaving Belgium and moving to Spain in this example. But what Belgium says, look, you've realized, or sorry, you've earned unrealized capital gains that during this period that you stayed in Belgium. And if you would not have left Belgium, you would eventually realize those gains. And we want to collect the taxes on those gains. Now, like I said, it's a liability that arises at that moment, but that does not lead to an actual payment in most circumstances the moment that you cross the Belgian border and leave to Spain. What will happen is that for the next 24 months, for the next 2 years after you have left Belgium, Belgium or the Belgian tax authorities retain a claim on any capital gains that you will realize during that 2-year period that relate to the time that you were a Belgian tax resident. So if during the 2 years after you've left Belgium, you sell any assets and when those assets contain unrealized gains that you now realized that relate to the period while you were a tax resident in Belgium, then on those sales transactions that you do within the first 2 years after leaving Belgium, you still owe capital gain tax to the Belgian authorities, and you are required to pay those taxes to Belgium, even though you're now a resident in Spain or another country. So that is applicable for the first 24 months after you leave. Then after those 24 months are over, and either you have returned to Belgium or you've stayed in another country outside Belgium, at that moment, the capital gain tax liability that might remain is released. So it's cancelled. And whatever you do, if you're still in Spain after those 2 years, whatever you do after that, the Belgian tax authorities cannot touch you anymore. Of course, if you return to Belgium within that 2-year period, this whole exit tax liability is removed because then you have a normal tax liability like any Belgian taxpayer would have. But I think it's important to understand for people that will leave Belgium at some point in time in the future that for the first 2 years after you've left Belgium, Belgium will still chase you for capital gains that you realize on any assets that you sell during that 2-year window. And after that, all your tax connections with Belgium are disconnected and you're no longer subject to Belgium exit taxes. There are a few requirements though, because what I just mentioned, this deferral of the tax claim and eventually the cancellation of the tax claim is only applicable if you move to a country that is a member of the European Economic Area. So that's any European Union country plus Norway, Liechtenstein, or Iceland. So if you move to any of those countries, this deferral is automatically provided to you. You don't need to do anything. Or if you move to a country outside the European Economic Area and is a country with which Belgium has a tax treaty, also for those countries, for those destinations, you will be automatically granted this deferral and eventually cancellation of your exit tax liability if you didn't sell anything. And only if you move to a country with which Belgium has no tax treaty, and there are quite a few of those countries, then you really need to actively apply for a deferral of your exit tax. And according to the law, what Belgium will then require is that you submit some kind of guaranteed collateral, probably in the form of a bank guarantee, which makes sure that Belgium, if you don't pay up yourself, is able to access that bank guarantee and through that way is certain that it can get those taxes from you in the future. So there are a few geographical requirements with this, and especially if you move outside the EEA to a country with which Belgium doesn't have a tax treaty, you really need to check what are the implications from a tax point of view. These are the highlights on the exit tax. There are a few other considerations when eventually you re-immigrate to Belgium after 2 years, or for people that come to Belgium for the first time. There are also certain specific rules for that. It's a bit too much to go into that detail tonight, but I think it's good to be aware that international movements to and from Belgium do have an impact on capital gain tax.
Very clear. Thank you.
Yeah, yeah. And by the way, this is not something typically Belgium. Most other countries have some form of exit tax. So I know, and that's also how I feel myself, that it's annoying that we have yet another tax in Belgium, but many of the things that we discussed tonight also exist in other countries. Then the biggest topic is how much will I actually need to pay? And it's an elaborate and quite complicated topic, and I'm going to try to make that as simple as possible. And there are, first of all, 3 steps that we need to go through to understand how this works. First of all, that's the starting point. I need to briefly mention that there are 3 different tax regimes, so 3 different ways of working within this whole capital gain tax. And tonight, for this purpose, or for the audience of tonight, I'm only going to talk about the third one, which is the general regime, which is the one that probably you've been reading a lot about in the media, which has the 10% tax rate and the 10,000 euro exemption that applies to, yeah, the normal private investor. The other 2 regimes, the internal capital gains regime, only applies to people that have interests in companies, that are direct shareholders in companies. And the substantial interest regime relates to shareholders who hold 20% or more in one specific company. So I'm going to skip those 2 first regimes. That's an entirely different chapter in the capital gain tax. And tonight I'm going to focus on the general regime that applies to you and me and most other everyday investors. So within that regime, first of all, and we're going to talk about that in the next few slides, for every individual sales transaction that you'll do after the 1st of January, you need to determine the capital gain or loss on each individual sale transaction. And you do that by taking the difference between the sales value and the acquisition value. And I'm going to talk about that a little bit more, how to calculate that, or what is part and what is not part of the acquisition and sales value. And I'm also going to talk about that expenses are not deductible, how to treat foreign currencies. I'll also give an example on the FIFO sequence of applying acquisition values. And like I promised, I will demonstrate why historical gains remain untaxed in one of the examples that is coming up. That is what you need to do for each individual sales transaction. Then after the year is over, you need to add up all of those transactions. And then there are 3 very important facilities that the law provides to us. That's first of all, that you can net any realized gains with realized losses. How that will work, I will show you. Then you can apply the annual exemption, the famous 10,000 euro, with a lot of special rules around that, which we're going to touch upon. And that will become clear a little bit later on, but now it might sound a bit weird. You can use higher historical acquisition prices in certain cases, but I'll explain that in an example once we get there. So first of all, general regime applies. Then for each individual transaction, we need to determine the capital gain. And then after the year is over, we need to add that all up and apply all the exemptions and facilities that are provided to us to not entirely remove the capital gains from us, but at least to make the pain a little bit more bearable, I hope. So it all starts relatively simple, I hope. So how do we then determine the capital gain tax on a transaction? In the most basic and simple form, it's the positive difference between, first of all, the acquisition value. So that's the price that you pay for an asset when you buy it, let's say 100 euros. And subsequently, when you sell that asset again, the sales value of that asset, let's say 130 euros. And very simply, and like I promised, this starts out relatively easy. In this example, you have a gain of 30 being the difference between the sales value and the acquisition value. But unfortunately, this is where the simplicity kind of ends, and there are a couple of other rules that we need to consider.
I think one thing to realize is First of all, it's not a tax on the entire value of the sale. So here it's only on 30 euros.
Yeah.
So if we didn't have all of these complicated exemptions and rules, it would be we have to pay 3 euros in capital gain tax, right? So, so one thing I want to highlight is that at this level, it's already a smaller tax than some people imagine. I've had multiple calls with people who were wondering, like,
it's not the end of the world.
Got the impression that they will be taxed on everything they have, which is not at all the case. But all right, let's carry on. I'm sure we're gonna have even more clarity on this as you introduce the other aspects of this.
True. Yeah, I want to stay away from politics, but socialism is a very expensive proposition, and being taxed on everything that you have is hopefully something that's going to be spared from us.
It happens in the Netherlands, so it's
absolutely
not far from here.
Yeah. No, the fiscal grass is not always greener on the other side of the border, and indeed, you only need to go one country up to the Netherlands to see that things can be a lot worse than what we have in Belgium at this moment. But I for clarity and not to upset people, I absolutely do not want to underestimate the level of taxes in Belgium.
Absolutely.
And it is absolutely true that in and by itself, if you look at this capital gain tax and compare that to other surrounding countries in the world, it's not that bad as such. My concern, and I think a lot of people have that, is that we already have extremely high tax rates on almost everything else in Belgium, especially on the income that you earn. I think we are world champion income tax. And also when it comes to investing, we already have a lot of different taxes that unfortunately don't go away. And I think that's for a lot of people, including myself, makes this so annoying that yes, the capital gain tax is not that bad as such, but it comes on top of everything that we already have.
Yeah, in fact, I was supportive of this initiative at first, even though I'm massively impacted because I only live from my portfolio of index ETFs. But it's because the expectation was that there would be lowering of taxes or some other form of, making things easier for everyone. Else, in fact, because it wouldn't help me much. And so from that sense, I thought, well, it seems that it would be fair to tax the capital gain tax and reduce taxes somewhere else, but it's not happening. Quite the opposite, in fact. So despite the government that's promised it, it's going just in the direction of more taxes. So that's sad to see.
True, and especially after their party last night when they had further budget discussions. It's anyway, maybe that's a topic for another day. and I want to stay objective and not become political. So let's make it a bit more complicated. What is included and what's not included in the acquisition and sales value? So if I buy a share of, let's say, 100 euros acquisition value, I also need to pay my broker, let's say 2 euros. And in Belgium, we have this stamp duty tax, the beursbelasting or tax boursière, which also comes on top of my acquisition value. So I don't pay 100 euros for that particular share, but I pay 103. If I then, a few years later, sell that same share for a price of 130, again, I need to pay my broker and I need to pay stamp duty tax on the sales transaction. So instead of receiving 130, I only receive 127 in my bank account after this sale is done. And from my perspective as an investor, my result is a gain of 24 at this moment. And you would expect that you would be taxed on this gain of 24, but unfortunately, that's not the case because the proposed law says that any cost or other taxes that you incur when buying or selling assets need to be excluded from the tax calculation. So in this example, I need to ignore my brokerage cost and stamp duty taxes, and I will be taxed on the gross difference between the 130 for which I sold my shares and the 100 for which I bought those shares, regardless of any other costs or taxes that I had to pay to buy or sell those shares. And here, Belgium, unfortunately, deviates from what I've seen in other countries, where usually those kind of transaction costs and taxes are tax deductible, but unfortunately, Belgium decided otherwise, which makes it more expensive for us, but also the calculation becomes slightly more complicated. So that's the first complication. Another question that I received a lot during the last couple of months is what to do with assets that I buy in a different currency than the euro. So for example, I buy some shares in Microsoft for, let's say, $1,000. Then what you are required to do is translate your acquisition value of, let's say, that $1,000 into euros using the exchange rate that is applicable on the moment of your purchase transaction. So let's say,
From the National Bank of Belgium, right?
yeah, yeah,
The official one for that
the
one,
official,
that
yeah,
day, because it's on a daily basis. Yeah.
exactly, yeah. So you need to take the exchange rate on the purchase date. Let's say it's €1.11. So that means that my acquisition value for these $1,000 shares in Microsoft will become €900. And that €900, that's the amount that we're going to work with once we sell those assets again. Because when I sell a few years later with a profit of $1,500, so my shares Microsoft have now increased to $1,500. And let's assume on that date, the official exchange rate was €1.20. Then I will receive €1,250 in return for those $1,500. And then that 1250, that's my sales value, and my capital gain tax needs to be calculated on the difference between that €900 that I just mentioned and the €1,250 on the sales value. So it's not, as I saw a few people suggest, that you make a gain of $500 and that once you realize that gain, you need to convert that $500 to euros using the exchange rate on the date of the sale. That's not how it works. You need to translate any acquisition or any sales value on the date or with the exchange rate of the date of that actual purchase or sale.
Yeah, and that makes sense, because
True.
if you had acquired that share in euros, it would have cost
Yeah,
€900.
yeah,
And if you
true.
had sold, then it would have sold for 1,250.
Yeah.
Um,
And of course, if you're doing these transactions from a euro account in your brokerage account, it will be automatically translated upon purchase and sale into euro. But some of you might have accounts with Bolero or Saxo Belgium that are denominated in dollars. And then you do need to make this conversion yourself because you won't see it on your account statement.
yeah, that's the case for me. So,
Yeah, yeah,
in fact, for the calculation of the tax on transaction, the stamp duty, it's already
mhm,
like this. You
exactly.
go
Yeah,
get the daily currency exchange rate from National Bank of Belgium, and that
yeah,
gives you the sale price in euros, and then you can
yeah.
do the calculation.
True. Yeah. No, you're
It's the
absolutely
same
right.
system.
Yeah, exactly. And again, that's not undoable, but it's a bit more work.
Yeah.
But it's
On top of everything else that's coming,
true.
it
Yeah,
becomes complicated. All right.
we're all going to be very good bookkeepers when this is done, whether you whether you like it or not. Okay, then this famous first in, first out, and I think a few people might be familiar with this system because it's also used for many different purposes like inventory accounting. But I did decide to include a little example here just to make it clear to everybody. So when does this apply? When you buy and sell an asset when you buy and sell the same asset at multiple moments in time against different prices. So the same share of a particular company or the same share in a certain ETF. If you do those purchases and sales on different dates, then FIFO applies. So how does this work? Suppose I bought an ETF once every year. In 2026, I buy 10 shares of €100. The next year, I buy another 15 shares for €90. Then the next year, 8 shares for 110, and the year after that, 5 shares for 115. If I then, a few years later, let's say in 2030, decide to sell 5 of those shares for €120 at that moment, then my sales value is 5 times 120 is 600 euros. And now in order to determine which acquisition value I need to apply for this particular sale, I should not use, and I think a lot of people are used to that because brokerage accounts in Belgium tend to show that, you should not use the weighted average purchase price of your previous purchases, but instead you need to use the first in, first out principle, which means that if you sell these 5 shares, you need to go back to the oldest purchase that you have of these shares, which in this example are the 10 shares that you bought in 2026 for the first time. And out of those 10 shares for 100 euros, you need to take 5 shares. I mean, on paper, you do this accounting wise. Take out 5 shares for 100 euros cost price, which gives you a cost price of 500, which you need to apply in this particular sales transaction to end up with a capital gain tax of 100 euros.
That's the capital gain, not the tax.
That's the capital gain. Yeah, sorry.
Okay.
Yeah, exactly. And that will then be taxed. Yeah. So you have a capital gain of 100.
Mm-hmm.
The next year, I'm going to sell another 10 shares of this same ETF for 130. So my proceeds are 1,300 euros. Out of those 10 shares that or those 10 shares that I then sell, the first 5 of those need to come out of the 5 shares that are still left in the oldest bucket of 2026. And because I bought 10, I already applied 5 for the previous purchase. So I still have 5 shares left in this bucket of 2026. So again, 500 euros for those first 5 shares that I'm now selling. And then for the next 5 shares that are part of this sales transaction, I need to go to the second oldest purchase in this sequence, which are the shares that I bought in 2027 for 90 euros. So out of those 15, I need to take 5 shares and apply that to the sale that I did in 2031 to end up with a capital gain of 350 in this particular example. And it means that out of those shares that I bought in 2027, I need to remember, or I need to account for the fact that out of those 15 shares, 5 are now gone and 10 are still left. So if I do another sales transaction, then the first shares to go are those 10 shares. And basically that's how you need to apply the first in, first out principle, which I think in this very simple example seems very doable, but buy and hold investors that might accumulate over years or even decades in the same ETF and then subsequently de-accumulate over many decades from the same ETF will have a very lengthy and long calculation to constantly apply all those buckets. The good news is if you are using a Belgian broker or a broker that is established in Belgium, then your broker will do all of these FIFO calculations for you. So as long as you're with a Belgian broker, I think it's good to be aware of how this works because then you do have an understanding how much taxes you will trigger by selling something, but the calculation and to keep track of this, those things are done by your Belgian broker. We're going to talk about the role of the broker in a few minutes, so that will come back.
All right, so the FIFO principle, just to summarize, the shares that I bought, the first ones, so basically there we have to keep track of the order of which we're buying shares and the price. Well, we don't have to, but someone has to.
Yeah.
And then when we sell, we will sell the oldest shares first. And the calculation will be then done between the price of sale at that point and the price of purchase of those oldest shares. And sometimes they will have different prices because we are selling more than just the oldest, but maybe the second oldest as well, which is where then we have to just add them up and get an average price thing.
Absolutely. You could have a sales transaction in the future where you need to apply the cost price or the acquisition price from multiple different purchases in the past. Yeah, that's true.
And then so purchases that are before the 1st of January of 2026, then there will be at a fixed price there. True. But everything that you buy that was that you sell that was bought after that, then we'll have variations in
Absolutely.
price.
Yeah, and that's a very good addition indeed. So thanks for that. That anything that you already have in your portfolio on the 1st of January 2026, that will be applied first, and only once you've exhausted, once you've used those shares and then sell later purchases, so to speak, then the FIFO applies.
So for people like me who stop contributing before the 1st of January 2026 and will only be selling, in fact, it will be okay, the math.
It's relatively easy. Yeah, true.
Because there's only
True.
one purchase price.
Yeah, yeah.
Everything.
So FIRE people, if you can, retire before the end of this year. All right. If you're not using a Belgian broker, but again, we're going to talk about this. This is all going to be your own calculation, but I'll come back to that. Okay, then a very important topic that seems to scare a lot of people, and hopefully I can take away that worry almost entirely, is the fact that historical capital gains that you've accrued before 2026 remain untaxed. And how that works, I think, is best illustrated using an example. So let's assume that in 2022, I bought some shares of an ETF or an individual company for 100 euros. So then that 100 euros was my historical acquisition value. And eventually it will become Wednesday, the 31st of December, 2025. And I'm still holding on to those shares in my portfolio. And December the 31st, 2025 is the last day before the capital gain tax becomes effective. And basically what you or your broker will need to do is take a photo. I think that that metaphor has been used a lot in the media, to take a photo of your portfolio of everything that you have just before the new capital gain tax becomes effective, with all the closing prices of at the end of this year. So in this example, let's say those shares that you bought previously for 100 euros are worth 150 euros at the end of 2025, just before the new tax will start. That means that until that moment, you've earned a gain of 500, which you have not realized. You didn't sell those assets, so you are sitting on unrealized gains of 50 euros. And those 50 euros in this example were never taxed before, but they also remain untaxed in the future, even once we have this new capital gain tax, because those 50 euros of gains were accumulated, were earned before this tax takes effect, and those will not be touched by the capital gain tax. Then 1st of January comes around and time moves on. And let's assume that in 2020 years, so a few years into the capital gain tax period, I'm going to sell these shares, which then have a value of 170 euros. So from my perspective, I made a gain of 70 euros from the historical acquisition value that I paid for those shares in 2022. But since the start of the capital gain tax, my gain versus that 150 euros on this photo moment, so to speak, is only 20 euros. And only those gains will be taxed under the capital gain tax. And like I said, the 50 euros that you accrued before that will remain untouched. And only the 20 will go into your tax return for the capital gain tax that you'll need to pay in 2029. I hope this example helps to clarify how this works. And I really want to take away any remaining worry that people might be suspicious of this. Legally, and that's even in the Constitution, it is extremely difficult and even more rare that any kind of law can be implemented with retrospective effect. And there's absolutely no legal basis to do that in these kind of cases. So there is no way on earth that this is suddenly going to be declared in effect with retrospective effect. So please don't lose any sleep over that. It's only going to be applicable on gains that you realize going forward.
Which is already enough.
Which is more than enough. Absolutely.
So two questions then here for you, Pieter.
Mhm.
First is, do you know Like what time of the day on the 31st of December? Or is it opening price, closing price?
It's the closing price. So basically you need to wait until the last exchanges in America are closed and everything is done.
Let's
It's the
hope
clo
the markets go up a lot just before
Absolutely.
we
Yeah.
increase that
Yeah.
price and
Yeah.
that we don't have a drop just before.
Exactly. That is, of course, is a worry that we have a big crash before the end of
It
this
would
year.
make things simpler as well for
True,
calculations
true.
later.
Yeah, exactly.
If
Yeah,
it's the all-time high, then okay, no
yeah,
questions, it's
yeah,
fine.
exactly. So everybody tonight, keep on buying, don't sell anything.
And then on the 1st of Jan, then it's okay if it goes down.
Yeah, exactly. It absolutely makes no sense to sell anything before the 31st of December with the idea of realizing a gain without having to pay taxes on that, because whatever you realize before the end of this year won't be taxed anyway. So there's no point in selling your entire portfolio and restarting again on the 2nd of January once the exchanges are open again.
It might actually bring the price down, which we don't want.
True, exactly. So don't do that. The only thing that you will do is hurt yourself by paying brokerage fee and
Transaction tax, yeah.
transaction taxes. So has absolutely no effect. There's a bit more good news here. So the good news already was that only gains going forward will be taxed, but there's more good news. Suppose, same example, but with one big difference, that I bought these shares in 2022, not for 100 euros, but for 160 euros. And that by the time it's the 31st of December 2025, the price of those shares have dropped to 150. Then obviously it would feel a bit uncomfortable, at least to me, if I then sell those shares a few years later for 170 euros, that I would still be taxed versus the 150 that those shares were worth on the 31st of December 2025, while I bought those shares for 160. Now, that's a concern where the tax authorities have said, okay, we're going to provide you with a bit of an exception. In the case your historical purchase price is higher than the value on the 31st of December, and you sell those shares with a profit later on, then you are allowed to throw away that photo, which has that 150, so completely disregard that 150 on the 31st of December, and instead use the higher actual acquisition value of those shares, which means that your tax will not be on a gain of 20, but will only be on a gain of 10, sorry, which is the difference between the 160 and the 170. So I think that already removes another concern that a lot of people had who said, well, what happens if I have shares that I bought for more than they are worth on the 31st of December? So I think this helps. It would have been nice if this is where the draft law would stop, but there's another complication here, which doesn't change the principle that I just explained. So this will still be there, but the calculation is a bit more difficult because what have they decided? Suppose, same example, that I bought these shares at multiple instances before 2025, 6. So let's say I bought one share in 2022 for 180 euros, one share at 170 the year later, and another share at 160 in 2024. You might say, oh, that's no problem. We just learned about this first in, first out problem, so we'll just apply FIFO on this as well. And if I now sell shares in 2029 for 170, I'll simply use FIFO and I look up what was my oldest purchase. Oh, that's 180. That's higher than the 150. So I'll use the 180 and I made a loss, so no gain, so nothing to be paid. However, what the law has come up with, and that's the only exception in the entire law that I'm aware of where FIFO does not apply, but instead where you are required to use the weighted average principle. So the actual purchase price before the 31st of December, if you want to use that, if it's higher, then the value on the 31st of December, you need to look at the weighted average of all your previous purchases. And I do understand why they included this, because it might look like another exception, but it will make things a bit more easier in terms of calculation. So in this particular example, like I said, it's the only place in the entire law that I could find where weighted average prices play a role. So it means you can throw away the price on that photo and use the weighted average price as your historical purchase price if that is higher than the value on the 31st of December, and use that for the basis of your tax calculation, which in this example means that my weighted average purchase price was 170 from the past, which happens to be equal to the price that I'm now selling it for. So I have 0 taxable gains in this example.
Yeah, that's nice because it makes the calculation simpler
True.
in case
Yeah.
the purchase price was higher.
Yeah.
I'm guessing that if the weighted average overall is below the photo moment,
Yeah.
then it's just the photo moment, even though
Correct.
some of the purchases were higher.
Yeah. Yeah.
Just to
Exactly.
simplify, and we have just one number to deal with
Yeah.
when anything that's been
Correct.
purchased before 1st of January
Correct.
2026.
Yeah. Yeah. So in that sense, it does make sense that here they use weighted average. Otherwise, for every transaction, you need to see if it's lower or higher.
You would have to go back so far in some cases.
Exactly.
Well, you know, in very few cases, because most of investments are going up during this time. But some people are
Yeah.
holding stocks that were traded very
Yeah.
expensive in the past. Yeah.
Yeah.
And
True.
maybe have lots of data on this, or you know,
Yeah.
lots
Yeah.
of transactions. Okay, so this
Correct.
makes things simpler. There's like we need to do the math once, and
Yeah. Yeah.
it doesn't necessarily feel more or less fair. It's just simpler. I think
No,
that's good.
no, it's the principle is the same, which I think is fair. And this way of calculating makes it a bit more less cumbersome. I do want to point out, and I will come back to that later, that this whole principle of using higher actual historical acquisition prices will not be something that your Belgian broker will do for you, even if you're working with Bolero or Saxo Belgium or whatever. This is a calculation that you need to do yourself, and you need to make this adjustment in your annual tax return yourself. But we're going to talk about that in a minute, so I'll come back to that.
That's not cool.
No, that's definitely not cool.
So I remember my second question. So if the regulation passes into law after the 1st of January 2026, then that date probably will have to move as well.
Yeah, and I think that's why they're so keen on
Just
making
getting
sure
it done.
that exactly that the law will be ready before the 31st of December, because only then it can be implemented.
Yeah.
And then, yeah, but indeed, if there are all sorts of objections and changes to be made, and the whole thing simply isn't ready, then I'm really curious what they're going to do. To be
Probably
seen.
will be pushed back a year.
Yeah. But
They
yeah,
don't want to do that, of course.
exactly, because we already have quite a budget deficit or a
Yes.
hole in the budget. So that would, I think they will do everything in their capacity to make sure that the law at least is passed, and then I think they don't care too much about the problem of the banks, unfortunately. This is what makes Belgium such a fun country.
Mm-hmm.
Maybe while we're at it, so I didn't include a visual example of this, but historical gains remain untaxed, but it also means that historical losses are not tax deductible, which I think also is fair, that if you are not taxed on the gains before this tax started, you can also not deduct any losses, except for the example that I just shown here, that if you sell something for at least 0 gain or a profit, and you have a purchase price that originally was higher than the value on 31st of December, you are allowed to use that higher purchase price. But if this calculation would result in a loss, so if your historical purchase price would have been, let's say, 200, you might say, well, then I have a loss of 30. That loss you cannot use for netting purposes. You are not allowed to deduct any losses from the past. Very confusing topic, I suppose. Let's see. Yeah. So what I've mentioned up till now is what is applicable to each individual sales transaction that you do as of the 1st of January 2026. At the end of each year, or after each year has passed, you will then be required, and that's the third step in this whole process, to add up all your gains and your losses. So let's say you've done a couple of sales transactions in 2026 on which in total you made a gain of 16,000 euros. The first nice part of the law, to the extent that the law is nice to us, is that it allows you to deduct any realized losses that you might have, that you've realized in 2026. Let's say you've also had a couple of sales on which you incurred a loss of, let's say, 3,000. Then you need to offset those losses against those gains, which means that only the net capital gain, in this example, 13,000, will be the starting point for the tax calculation. So I think that's an important first facility that is provided by the law, that realized gains, if they happen within the same year and by the same taxpayer, can be offset against realized losses of that year. So that only the balance of gains and losses will be the starting point for the tax calculation. So we're going to start with a net capital gain here of 13,000 euros. Now, because we haven't touched upon that yet, finally, this base exemption or annual exemption comes into play. So from your net capital gains, you will now deduct your 10,000 base exemption, which will lower your taxable base to 3,000 euros in this example. 13,000 minus the exemption of 10,000 is 3,000 taxable base. And on that 3,000, you need to pay 10%, which gives rise to a tax liability for 2026 of 300 euros, which I know if you look at it in this example, doesn't look too bad still. But of course, if you are a good buy and hold investor, and hopefully we're going to have many, many years of nice returns, then your realized gains become a bigger and bigger part of your total portfolio. And then, of course, these things really can add up. But especially in the first few years, yeah, this is not too bad still. Of course, again, not nice, but it's not going to be the end of the world, at least not in the first few years.
Yeah, so I was doing some modeling for myself and I created a model that I shared with a few people.
Yeah.
And it's true that because it's me and my wife together, we have a base exemption of 20,000.
Yeah.
And in fact, we're not paying any, like if the stock market grows at a sort of normal return for the next few years, we're not paying taxes until 2030 at the earliest, maybe even later, depending on the growth and the capital gains. But so for those who are now relying on the income of their portfolio and are selling and making capital gains to live from, it's still okay for a while. It's not going to hit us right away, but it's true that after a while, the capital gains become the biggest chunk of whatever sale you make, and then it's a high percentage then.
Yeah, I'm in a similar kind of situation and made the same kind of calculation. And for now, it looks okay, but it's gonna come back in the future.
Yes.
As you mentioned, Sebastian, that indeed the exemption is per year and per person. So if you are a married couple, you both have your 10,000 euros, which you either can apply to your own separate investment account if you have separate accounts, separate assets, or if you have a joint account, you can use that towards your joint account and you'll have an exemption of 20,000.
Isn't this just joint finances or separate finances?
Yeah, correct. Yeah, it depends on
because
how
even
you are
if you
married.
have separate accounts but joint finances,
True. Yeah. No,
it's
you're
still
absolutely right. That's more accurate. Yeah. The your marriage contract is the determining factor here mostly. Yeah. We all know about the power of compounding interest, of course, and there's a bit of good news here in the sense that the annual exemption will also be adjusted for inflation. So that also has a compounding effect, which is positive in this case, in the sense that the 10,000 euro after 2026 will grow with inflation. So that also helps to offset future tax gains that might arise. And part of this exemption, if you don't use it, maybe carry forward to subsequent years up to a maximum of 5,000 euros. And that's particularly a topic I want to talk about a bit more, because I found that quite confusing when I first read about this in the media, and only after I really went through the law and the memoranda, it became much clearer to me how this works. And the reason I want to spend a little bit of time on this, and I know I've been talking already quite some time, is that also this accounting for this base exemption and how this carry forward of unused parts, all of that is something that you'll need to do as a taxpayer yourself. So if you really want to make use of these provisions, you really need to be on top of this and keep track on what you've used and what you've carry forwarded to the next year. So how does this work, this whole mysterious exemption and this extra 5,000 euros that a lot of people talk about? So to try to visualize this, in the first year, 2026, you'll have an exemption of 10,000 euros. And I think the best way to explain this is that you need to think about this 10,000 euros as consisting of two separate buckets. The first bucket is the first 10% of that 10,000 euro, which is 1,000 euros in 2026. And the second bucket is the remaining 90% of that exemption. And the reason why it's important to mentally and visually split the exemption into these two buckets is that how the law is intended is once you start using your exemption, you basically in this diagram go from the top and you first start to use or eat into the first 10% of the exemption. So if you made a gain and you want to apply your exemption against that gain, the first part that will go is that first slice, that first bucket of 10%, which is 1,000 euros in 2026. If you don't touch any of that first bucket, if you don't have any capital gains that you offset against your exemption in the first year, then the entire slice, that entire first 10%, can be carried forwarded to the next year. So that means that on the 1st of January 2027, you will get your 1,000 euro from the previous year, which is completely untouched. You haven't used anything from your exemption. And on top of that, you'll get a new annual exemption of 10,000 euro or whatever the inflation adjusted amount will be for 2027, but I've ignored indexation for now. So that means that you'll start 2027 with a total exemption of 11,000 euros instead of the 10,000 euros. So it's important to separate that exemption into two buckets. And to take that example a little bit further, if, for example, you did do some sales transactions in 2026, and let's say you realized a gain of 500 euros on that, for which you want to use part of your exemption, then first, that 500 euros, you need to take out of that first slice of 10%. So from that first slice of 1,000 euros, that is eligible for carry forward to the next year. From that slice, you start to use your exemption, 500 euros in this example. And if that's all that you've used, then the remaining 500 from that first slice is still eligible for transfer to the next year, which means in this example, you'll start 2027 with 10,500 euros. The moment that in the first year you would use up the entire first part of 10%, the entire 1,000 euros or more, you can't transfer anything to the next year anymore. So I think hopefully that already helps explain a little bit how this transfer works. But to make it even more clear, I came up with a bigger example. So, and I do want to take some time to go through that together. So every year, as I think is becoming clear now, you will start the new year with a new annual exemption. And for now, ignoring indexation, I've assumed that every year you will start the year with a fresh 10,000 euro of exemptions. or exemption. Now let's assume that in the first year, 2026, you start with 10,000 and you don't sell anything in that year. So you're not using any of your 10,000 euros. And taking the example that we just saw, that means that from your unused balance, which is 10,000 euros, you are allowed to carry forward 1,000 euros to year 2. So that means that year 2, 2027, you'll have 1,100 euros, just like in the example before, at your disposal as a total exemption for that year. To also use the previous example, let's assume that in year 2, you have a minor sale on which you realize 500 euros gain, and you will use that gain to offset against your exemption. Then also here, the FIFO principle applies. So first, you need to use up the oldest part of your exemption, which in this case is the balance that you carry forwarded from the previous year. So you will first use that 1,000 euro that came from 2026. And from that, you will deduct the 500 euros of realized gains in 2027, which means that from your carried forward balance of 1,000 euros, you have 500 euros left, and you are allowed to carry that remaining balance forward another year to 2028. But it doesn't stop there, because the 500 euros was the only thing that I applied against my exemption in 2027. I didn't touch my new exemption of 10,000 euros that I received on the 1st of January 2027. So nothing has been used, which means that from that exemption for year 2, I am entitled to a carry forward of a fresh 1,000 euros to 2028. So in this example, I will start year 3 with a total of 11,500 euros in exemptions that is now available to be used in year 3 in this example. Let's assume that in year 3, I'm making bigger sales or realizing much more gains. And in total, in that year, I'm realizing 3,500 euros in gains, for which I want to use my exemptions. Then the FIFO rules says, against that 3,500 euros of capital gains that I made in that year, I first need to take the oldest part of my carried forward balance of 500 euros that came from year 1. Then I need to take the second oldest part of my exemptions, which is the 1,000 euros that I carry forwarded from year 2. So my entire 1,500 euros that I had available from previous years is completely used up. So I have a remaining balance of 0 in that bucket. And the remaining 2,000 euros that I realized that year, which I want to offset against my exemption, I need to take out of the 10,000 euro for year 3 itself, which means I've used up more than 1,000 euros from the exemption related to year 3, which means at the end of year 3, I am not allowed, not entitled to any carry forward to 2029. So 2029 will start with a fresh 10,000 euro of annual exemptions, but no more balances carried forward from previous years. And then the whole thing basically starts again. If I then don't have any sales in 2029, I don't use my exemption. That means I can carry forward a new 1,000 euros to 2030, which means 2030 will start with 11,000 euros. If then in that year, again, I don't sell anything, I can carry forward that 1,000 euros from the previous year, plus I'm entitled to a new carry forward from 2030. So 2031 will start with 12,000 euros. If I then repeat the same in that year, I don't have any sales in 2031. I carry forward the entire 2,000 from the previous years, plus I'm entitled to another carry forward from 2031 of another 1,000 euros. So 2023 will start with 13,000 euros. And of course, if I continue working like this, and if I don't use my exemption for 5 subsequent years, this will eventually all add up to 15,000 euros of available exemptions. And that's the maximum allowed for these carry forward amounts. So in that way, if you don't have any sales transactions, yeah, your exemption will gradually increase during the course of 5 years. And to make it a bit more complicated, all these amounts will be adjusted for inflation, from which I completely ignored in this example, just to show the principle of how this carry forward from one year to the other works, and also to highlight that for the carry forward application or the use of those balances, you also need to consider the FIFO principle, where you always first use up the oldest available carried forward balance before you start touching your annual exemption. I know this sounds complicated, but I think this is the simplest way I could think of trying to explain this. And like I said, unfortunately, this is something that we're going to need to do ourselves.
So I'm trying to summarize.
Yeah.
So any transaction that we make in a certain year that triggers capital gain tax will eat directly into any potential carry forward 1,000 euro chunk for the following year.
Unless you decide not to use your exemption, because that's also a possibility that you say, look, I made a sale, I have a profit, and
let me pay the tax now.
Exactly. I'll pay the tax now, and I'll keep all my exemptions or all my balances that I carried forward or whatever. That's up to your own discretion.
So basically, as the year passes, you will not be able to have, like if 5 years pass, you will not be able to have any carry forward if you've had 5,000 worth of capital gain tax over those 5 years. Basically, you can, like, unless you decide not to use the exemption.
Yeah, exactly.
Right? Or
so the only way to get to this famous 15,000 or 30,000 for married
to
couples,
not use it for 5 years.
Exactly, is to not use it, not to touch it.
Okay.
Yeah.
You were saying we need to do this ourselves, the brokers. Is this something you're going to speak about?
Yeah. Brokers won't do this for you, unfortunately.
So we will need a new type of accountant.
Exactly. Yeah. So I think everybody needs to get busy in Excel to keep track of this.
Isn't there? Yeah. Okay. Let's carry on.
I'm aware of several people in Belgium that are already building websites and all sorts of tools that hopefully they will make available to us next year to do all these accounting things in a bit more automated way.
Yeah, I think this is something we can cover in an upcoming event.
Yeah, exactly.
There's a lot more we can cover.
Yeah, exactly. Yeah, so hopefully there will be some help on this by websites or whatever, probably paid services, but
maybe even the government, no? Hopefully some free system that
who knows?
that can be linked to,
True. Yeah.
All right.
To wrap this topic up, and I think that is something that we're going to come back to in maybe a subsequent discussion later on this year, is that I do think it makes really a lot of sense to review your investment portfolio at the end of each year or towards the end of each year, maybe in Q4, in relation to all these facilities. So first of all, there's the possibility to offset profit and losses with each other. And then this whole tax exemption story is an important one. And those things combined, of course, it does make sense in your normal transactions that you would do anyways for your investing, or maybe you're decumulating from your investments, or you're doing some rebalancing that you want to do anyway, that towards the end of the year, you make sure that you use all of these facilities to offset gains and losses that you have incurred anyways, and to apply your base exemption if you want, and also to discuss this or to apply this higher historical acquisition value if that is applicable, as we just discussed. The big question, and that's also a question that is asked a lot on various Facebook groups and other platforms, is does it make sense on top of the transactions that you would do anyways to force certain sales towards the end of the years, maybe even with an immediate reinvestment of whatever you're selling, in order to realize some losses that you didn't intend to take, because you might have a loss on a share or an ETF, but you still might want to hold on to that share or ETF because you think things will turn out better in the future. But for tax purposes, it could make sense in certain cases to sell those assets with a loss, maybe and then immediately followed by a reinvestment because you want to keep those investments in your portfolio, but with the only purpose of realizing a loss that you can then use in order to offset that against gains that you have elsewhere in your portfolio. And the same is true if you have still an unused part of your exemption. So if during the normal course of the management of your portfolio, you haven't reached capital gains up to the maximum of 10,000 euros, that you decide to force a sale of assets that you didn't intend to sell normally, but that you sell for the only purpose of generating a high enough profit in order to use up your maximum exemption for that year, and then 5 minutes later reinvest the same amount in the same investment because you want to hold on to that investment. Both Sebastian and myself independently have done all sorts of modeling on this already, and I think there's not a right or wrong answer in whether you should force a certain sale to trigger these kind of facilities, and it really depends whether that makes sense on a couple of factors, on a couple of things. First of all, and you really need to be careful with that, of course, by doing this, you will trigger brokerage fees and transaction taxes, stamp duty taxes on a transaction that normally you would not have done. And that can really add up, those fees. And there you do have the disadvantage of compounding, because those costs you pay for in year one will leave your portfolio permanently. And that's a value that is permanently withdrawn from any future gains that you might have in your portfolio. And well, we all know the rule of 72, probably, that at a 10% rate of return, within 7 years, your amount doubles. But that rule also means that if I pay 500 euros in brokerage fees and stamp duty taxes just to trigger some gains, which allow me to use my 10,000 euro of exemption, which gives me a tax benefit of 1,000 euros, that 500 euros that I make in year one adds up to 1,000 euros 7 years down the road at a compounding rate of 10%. So for the long-term buy and hold investor, please be aware of the compounding effect of these costs, because what I've already seen myself in some simulations that I've done, that takes out a bigger chunk of your tax gain that you do indeed realize than you might be aware of. So be careful with that. But beyond that, I think it really depends on two things. First of all, that's your own personal expectations on future tax rate increases. If you are convinced that this tax rate of 10% will increase to higher percentages in the future, and I wouldn't blame you if you share that thought, then it becomes more attractive earlier on to force certain sales to at least realize some gains at a rate which is now still 10% instead of paying potentially a much higher rate in the future. So even though at 10% it might not make sense, you could still decide, depending on your, basically your risk view on tax rates, to still go ahead with a forced sale in order to realize the 10% tax rate at this moment. But more importantly than that, and I think that's the key driver, and here I'm using a term that Sebastian used for the first time, and that's what Sebastian rightfully so calls the gain ratio. And I think that's really the determining factor. And what we mean by gain ratio is the ratio between unrealized gains on a certain investment versus the acquisition value. So versus the purchase price that you paid. And that unrealized gains as a percentage of your acquisition value needs to be high enough in order to make it worthwhile to force a sale in order to use your annual exemption. Because if that gain ratio is not high enough, what you'll end up doing is selling such a big part of your position that your brokerage fees and stamp duties really take out too much of your gain. And it only becomes worthwhile if you made so much profit. So if you have so much unrealized gains that you only need to sell a relatively small portion of your position in order to reach your exemption. And I think the gain ratio, that's really the determining factor. And for my calculations, I think I didn't calculate that as precisely as Sebastian did, but I think it starts somewhere around 10% or higher, and below that, and certainly below 7%, it becomes a bit more questionable whether it makes sense to do this. The size of your portfolio or your position plays no role in this. It's really the relation between unrealized gains and acquisition value.
Yeah, do you
I don't
think
know, Sebastian? Yeah.
I coined a new term there now? It must exist somewhere else.
Yeah. Well, I heard it. I heard you mention it the first time, so I think the credit for that term goes to you.
For now.
For now.
It
Yeah,
would be nice if people could say, hey, yeah, the gain ratio as described by Sebastian
exactly,
in the
exactly.
newspaper. That would be cool. No,
I
I doubt that.
I even referred to you in a similar presentation that I did in Dutch last week. So credit where credit is due.
Well, thanks.
Yeah. All right.
Um,
Very quickly, the last topic. How will the collection work? What is your role and what is your broker going to do and not going to do? So the first example, if you're using a broker that has a permanent establishment in Belgium, so Bolero, Saxo Belgium, Rebel, Keytate Bank, those kind of brokers, that's the most simple version. What will happen here is that your broker, if you don't tell him otherwise, and I'll come to that in the next slide, what your broker will do is on each individual sales transaction that you'll do after the 1st of January, your broker will withhold the full 10% capital gains tax on that particular transaction, on the profit that you made through that transaction. And I will explain in a minute, because that's a key element in this discussion, what the exonerating effect means. Very difficult terminology here, but it'll become clear in a minute. What it also means is that your broker, even if you're working with a Belgian broker, will completely ignore your annual exemption, because your broker does not know, first of all, if you even want to use your exemption, but your broker also doesn't know what accounts you might have with other banks or brokers. So it's not that your broker doesn't want to do that. It practically cannot apply the exemption for you for this reason. Your broker will also not do any netting of realized losses. So it will only take into consideration sales transactions with a profit and simply apply the full 10% tax on that profit and completely ignore any losses. And your broker, lastly, will also not use higher historical acquisition values if those are applicable, like we previously discussed. So what this means is you could stop at this moment. You could say, look, my broker already withheld the maximum amount of capital gain tax that I need to pay on the transactions that I've done with this broker. And that's where this difficult term, this exonerating effect comes in, because what exonerating means that at this moment, technically speaking, you are liberated. That's what exonerating means. You are freed or liberated from filing any tax return for the capital gain tax. Because at this moment, you could simply say, look, all my taxes to the maximum amount have been already withheld by my broker. And if I don't use my exemption and other facilities, that's my loss as a taxpayer, but the government already has received the maximum amount of taxes that they are entitled to. So they say to you indirectly, if you don't want to do your tax return, that's perfectly fine. You are free to ignore any of the exemptions at this point in time. You will see in a minute why that's important. So that is what happens during the year. at the end of the year or after the year is over, your Belgian broker will send you a tax statement that simply is a very nice listing of all the sales transactions that you've done in that year with the gains or losses that you've made. And where you've made a gain, they will indicate that they have withheld 10% on your behalf and paid that already to the government. And you will receive that statement no later than at the end of February of the following year. And with that statement, you now have the option, but not the requirement, to do a tax filing for your capital gain tax in your annual Belgium income tax form. And filing capital gains in this scenario is optional because you were liberated, you were exonerated from any filing of capital gain tax because your broker has already withheld capital gain tax to the maximum amount possible, and you could decide to stop here and not claim your exemption, not net of any realized losses, and not use any higher historical values for previous acquisitions if that is applicable. But of course, if you are like me and you do want to make use of those exemptions and facilities, you would of course fill out your capital gain tax part of your annual tax filing, which will be added to the form that we currently have. So the tax form will look a little bit different going forward. And then through your annual tax filing, you can claim those exemptions and other facilities. This has an important consequence, and a lot of people have already picked up on this, that it might be the least amount of work for you as a taxpayer, but it means that you are pre-financing the government because you are paying these taxes at the date of each transaction. And by the time you've filled your you filed your tax filing and you received your tax settlement and you finally get your money back, potentially 2 years might have passed since the first sales transactions that you've done. So you're basically providing a loan to the government for potentially up to 2 years in this example, which is a bit of a annoyance. There is an escape from this, and this, I think also many of you have already picked up on, is the so-called opt-out option, which is only applicable for Belgian brokers. And what that means very quickly is that you can basically tell your broker explicitly before the start of each calendar year to not withhold any capital gain tax at the source on each transaction. So your broker will say, okay, that's fine. We will not do anything for you during the year. But that also means that there is no exonerating, no liberating source tax being withheld. So at the end of the year, the tax authorities have received €0 on your behalf from your broker. And of course, you will still get the same tax statement from your broker. And with that, you will need to fill out your capital gain tax part of your annual tax income statement. But now, contrary to the previous example, it becomes mandatory to do that because no taxes were paid yet. And it also means, and some people find that a disadvantage, is that by having this mandatory tax filing, you need to be willing to disclose all your sales transactions that you've done in a particular year, because that's what is happening in this scenario. So the advantage is you only pay the taxes after the year is done, so you're not pre-financing the government, but you do need to fully open up your books to the tax authorities, whereas in the previous example, without the opt-out, the tax authorities will only see those transactions for which you apply any exemption or any of the other facilities that I mentioned. So some people find this a bit annoying that there is this transparency if you use the opt-out option. And lastly, and that's not something I would look forward to, if you are using a broker which is not established in Belgium. So I've used a random example, but that's really not to pick on the Giro, but I think that is a common example. If you're investing through the Giro in the Netherlands, your foreign broker will completely ignore the capital gain tax. There obviously will also be no exonerating capital gain tax being withheld at the source. But more importantly, you will most likely 99.9% sure not get a Belgian tax statement from your Belgian broker. I specifically contacted the Giro for this a month ago, and they said, yes, we are aware of these tax developments, but we have no concrete plans in supporting this, as we are not doing that for any other country because it doesn't fall in their scope of support for these type of taxes. So that means, again, a mandatory filing of your capital gain tax, for which you are now really entirely on your own, and you need to do all the accounting, including this FIFO thing and all the calculations completely by yourself, which is complicated, very time consuming, very easy to make mistakes, and also the burden of document retention for future tax audits is completely with you, and you really need to collect all the statements and make sure that maybe many years down the road you are still able to demonstrate what you've done. And because of this FIFO way of working, until you've sold the very last share of a particular investment, you will still need to keep track of all the history from the very first day in order to demonstrate what you've done in a particular year, because that's the consequence of FIFO. It all builds one year on top of the other. So I think people using a foreign broker really need to consider if this is what they want to do going forward. Very quickly, what other taxes are we impacted with that you're probably familiar with? We have the transaction tax or stamp duty tax. There was a bit of discussion at the beginning of this year that maybe that might be harmonized and simplified as well, but that for now seems to have gone away. So no change there. Also, the existing withholding tax on interest and dividends will stay for now. There's also no speak of that being removed. The 1.5 tax on accounts with values over 1 million euros, kind of a wealth tax, will also stay in effect. The insurance tax, there was also a bit of discussion at the beginning of this year that that would be lowered. That's also been cancelled. Also, the so-called miscellaneous income tax on abnormal or speculative management of assets remains in effect. So yes, there is a 10% capital gain tax on transactions, but if the tax authorities consider that you're doing abnormal or speculative transactions in your portfolio, then those transactions will still be taxed at the much higher rate of 33% that we currently already have for the miscellaneous income tax. And that's where people are worried about this full transparency, that with the full transparency that you're going to provide through making use of the opt-out possibility, it's going to be much easier for the tax authorities to spot any abnormal or speculative behavior in portfolios. And lastly, I'm going to mention this, and this is something that we're going to return to later on, is the Reinders tax, the infamous Reinders tax on fixed income investments, which will continue to stay in place, but in a modified version, which will sit alongside the capital gain tax. And luckily, there are provisions that there is not going to be any double taxation of the same gain by both the Reinders tax and the capital gain tax. But how these two taxes will interact with each other, I find too unclear at this moment, at least for myself, to really go into that in detail. So that's going to be something for another date, probably. And then lastly, what should you do now? Should you do anything? And I think here our dear late friend Jack Bogle quote of "don't do something, just stand there" also applies. That I think for now, there's no reason for panic. And I think the best way is to wait and see what will happen in the next few weeks and months to come. And I think we also need to agree that the tax is annoying, but that investing still remains an attractive proposition despite the new tax. We still need to see and wait what is going to be the final legislation going forward, which is on certain technical elements a bit of a moving target. And like I mentioned, there is really no sense in forcing any sales before the 31st of December this year to avoid any capital gains tax going forward. On equity ETFs, especially, the accumulating version, of which we're a big fan of, remain the most tax efficient for equity investing. So there's no need to switch to a distributing variant because of this tax. And like I said, for bonds, we do need to see how certain technical elements will be interpreted in the weeks to come. And the same I find is true for derivatives, where I can also easily think of 10 questions which are not answered in the existing documents that we have available to really understand how derivatives will be treated from a technical point of view. Maybe, like I said, if you are working with a foreign broker, you might consider switching to a broker in Belgium. And for business owners, to the extent that those are in this session, I think those people do need to consider looking into the valuation of their business before or per the 31st of December 2025. And I think it makes sense to already talk with your accountant or auditor how to approach that. And also for people that are business owners with larger businesses, review your existing structures in terms of tax and succession planning, because this new capital gain tax might shed a new light on certain elements, especially on the succession planning structures. So that's something that you might already want to start to look into right now. I think we've discussed a lot, and I know I've used up more time than I intended, but I think maybe hopefully there is a bit of time for Q&A. Before I close and give the floor back to Sebastian, yesterday through Tim Nijsman's LinkedIn channel, we published a document on the meerwaardenbelasting in Dutch. I don't have the intention to translate it to English at this moment in time, but maybe if I really become excited, I might do that in the future. But for now, it's available in Dutch. So what you need to do if you want to have that 27-page document that basically describes what I just mentioned even in a bit more detail, go to Tim Nijsman's LinkedIn profile and do what you're supposed to do there, and then he will send it to you. And if
I'm posting the link to the
excellent.
posts that Tim shared. So this is the link directly to where you can go and comment and get access to this.
Fantastic. And if on top of that, on top of what you're already doing through all the great courses with Sebastian, you consider also becoming a client of the Vermorgensgids, then you can use this QR code or the link that is provided below to directly go to my online agenda, where you can book an introduction call where I can explain our way of working and our fee structure and what we do for our clients at the Vermorgensgids.
Yes, and when you do so, tell them you're coming from FIRE Belgium.
Absolutely, yeah. And that's also going to be the first question that I'll ask. Where do you come from? How on earth did you find us?
Yeah, we are collaborating a lot with Vermorgensgids anyway. We've had Tim Nijsman on the podcast a couple of times, and I think we're going to bring you guys more often to the podcast because
more than happy to do that.
This is amazing, Peter. Thank you so much. I would like to invite everyone to turn on your camera and your microphone, if you can, if you don't mind, saying a big thank you to Peter. I would even allow you to unmute yourselves so that you can even tell him thank you directly. It'd be great if you could all come and turn your camera and at least say hi and wave like this. We're gonna record this, and I want people to know that there's a lot of gratitude for the work you've done, Peter, because Peter is probably dreaming of capital gain tax right now when he sleeps, because you spend so much time on this. To the benefit
this has been
of all
my
of us.
summer indeed. Yeah,
you spent months on this to the benefits of all of us. So everyone, if you can wave like this on the screen, that would be great, because then we'll have a
thank you, Peter.
A picture. Hey, Rakesh.
Thank you very much.
You're welcome. Good night, everybody. Don't have nightmares about the capital gain tax.